don't guess and make a mess with QSBS. That's the subject of today's ACTEC Trust and Estate Talk.
Welcome to ACTEC Trust and Estate Talk from the American College of Trust and Estate Counsel, a professional society of peer-elected trust and estate lawyers in the United States and around the globe. This series offers professionals best practice advice, insights, and commentary on subjects that affect our profession and clients. And now, our ACTEC Fellow host with today's topic.
This is Travis Hayes, ACTEC Fellow from Naples, Florida. Today we will hear about how clients should be planning with qualified small business stock, also known as QSBS, and how the proposed legislation being discussed in Washington, D.C. could affect that planning. To discuss this topic, you'll be hearing today from ACTEC Fellow Justin Miller of San Francisco, California. Welcome to Justin.
Thank you very much, Travis. So, as Travis mentioned today, I'll be covering just a brief overview of qualified small business stock, QSBS, and I also am going to touch on the proposed legislation that we're seeing right now, that as of at least mid-October 2021, and how it might impact that planning. So let's just start. Qualified small business stock, QSBS, or if you really want to impress your friends at a cocktail party, you can call it Section 1202 stock, because that's the section of the Internal Revenue Code that covers QSBS. So what is it? Well, let's just start from the very beginning, a very quick overview. QSBS provides a benefit for the greater of $10 million or 10 times basis, whichever is more, to be excluded from capital gains, greater of 10 million or 10 times basis. So if you are a founder or an executive or an investor in a qualified small business, it's got to qualify. We'll get to that in a second. It is a tremendous tax benefit. It is the greatest thing since sliced bread for small businesses. Now, how does it work? Where does it come from? Now, the original rule came out in 1993, went all the way through to February 2009 and provided a 50% exclusion. Now, focus on that 50% number because I'm going to come back to that at the end. That is where the legislative proposal right now in mid-October 2021 is proposing to go back to. But the original 50% exclusion said the greater of 10 million or 10 times basis, half of that amount is not subject to tax. The other half is subject to tax. And not only that, it's subject to tax at the rate that was in effect back in 1993, which is a 28% rate. So effectively, you'd be paying a 50% or a tax on 50% of a 28% rate, which means you're basically paying about a 14% tax. But it doesn't end there. With the 50% exclusion, it means you're also subject to AMT, because it gets added back as an AMT preference. You're also subject to the part that's taxable, at least, to the 3.8% net investment income tax, so additional 3.8% surtax there. And if this proposed legislation passes, you also may be subject to that additional 3% surtax that has been proposed. So the 50% exclusion is good. It's just not as great as what happened in the more recent years. So in 2009, the exclusion percentage was increased to 75%. And then again, quickly thereafter, for everything that you acquire the QSBS on or after September 28, 2010, you get a 100% exclusion. That means if you've acquired the stock, whether you're the founder, the executive, the investor, if you've acquired it after September 27, 2010, 100% of the first 10 million or 10 times basis completely excluded from taxes. You have no AMT issue, no net 3.8% net investment income tax. As I said, the greatest thing since sliced bread if you qualify. Now, not everyone qualifies. There are a bunch of rules. They're all under Section 1202, and we start with you have to have a C corporation. Now, there are some rules if, let's say, you start as an LLC or a partnership and you convert to C corporation, may even be possible with an S corporation, but to have it qualify, it's got to be stock from a C corporation, and you have to have received that stock directly from the issuing company. So you can't just buy it from a third party, or someone individual can't sell it to you. You've got to get it directly from the issuing company. So that means a founder, an executive, or somebody investing in the early stages. Now, it also can mean you got it directly from the company if you get it from one of those people by a gift or inheritance. So we're going to get to trust planning that qualifies under these rules. It's as if you got it from the original person. You kind of tack on that holding period and you tack on their qualifications. There's some other rules. It's got to be a small business. That means gross assets cannot exceed $50 million through the time you actually received the stock, to the time where the stock was issued. So that means if you've got an executive in 2012, they exercise some options or some restricted stock, the restrictions lapsed or whatever it was, they got their stock in 2012 while it was under 50 million. It did not exceed 50 million. That is qualified small business stock. Now, let's say the next year, a whole big capital infusion comes in. They do another series round. It exceeds 50 million. From that point on, whatever stock they get will not be qualified small business stock. So you looked at the point where you want to time it is when did you get those shares of stock? When did you get it? And was the C corporation, were the assets 50 million or less at that time? So that's the rule. Now, there's nothing you have to file. The company doesn't file anything. There's no special like 83B election that you have to alert anyone to. You either qualify or you don't qualify. And oftentimes, a lot of executives, founders, they don't even realize they have QSBS until a really good group of advisors comes in and starts planning with them and says, hey, when did you get the stock? What were the gross assets at the time? You don't want to miss out on this benefit. A few other qualifications, not only that $50 million number, but it's got to be a special type of what's called a qualified trader business. And the company has to use 80% of its assets actively conducting that qualified trader business. So there's a whole bunch of exclusions like banking and finance, insurance, farming, mining, restaurants, hotels, even professional services. Once again, lawyers, doctors, accountants, completely excluded from this QSBS benefit. The other requirement is you have to have held the stock for at least 5 years. Now, if it's gifted to a trust, you get to use the holding period of whoever gifted it. So if I've held it for 3 years, I put it in a trust for my kids, a non-grantor trust, that trust has to hold it for only 2 more years. So you've got to make that 5-year requirement to get the exclusion, greater of 10 million or 10 times basis. Now, what happens if you're 4 years and 6 months in and someone offers you an insane amount of money for your shares, you're having a big liquidity transaction, you don't make the 5-year period? Well, there is an ability, it's a different code section, section 1045, that says you can roll over your qualified small business stock into replacement qualified small business stock. You only have to hold it. You get to tack your holding period, so you'd only have to hold it for another 6 months to make that 5-year period and then get the entire greater of 10 million or 10 times basis excluded. In fact, you can even start up your own qualified small business stock. So if you have 6 months to go and you're willing and it's going to be a legitimate business and you do all crossing your T's, dotting your I's, and you want to start your own qualified small business with a C corporation, you can do that. It better be legitimate. But if you change your mind in a year or two and you decide, oh, it didn't work out and you want to take all your money back out, as long as it was a legitimate transaction at the time and it was a replacement qualified small business stock, you can meet your 5-year holding period. That's QSBS in a nutshell, qualified small business stock. Now, how are people planning with it, or how should you be planning for it, or how do you really leverage this exemption? And the reality for the world of trust and estate planning, when you think about children and grandchildren, non-grantor trusts are the way to go with qualified small business stock. Now, don't get me wrong, non-grantor trusts have advantages, especially if you're in a high-tax state, like let's say New York or California, where you want to set it up in a non-grantor trust jurisdiction. Let's say a place like Delaware, Alaska, Nevada, South Dakota, not only no state income tax, but better asset protection. Non-grantor trusts have advantages. In fact, with the proposed legislation, non-grantor trust could become even more popular in the future. But where it really shines, and we'll talk about the rules before the proposed legislation, is with qualified small business stock planning, because every non-grantor trust you set up gets its own greater of 10 million or 10 times basis exclusion. So I'll quickly walk you through a hypothetical, and then we'll talk about the proposed legislation. So hypothetical would be, let's say you've got a client has 3 children. The client has 10 million exclusion. Let's say an original founder or executive has 10 million of QSBS. That's the only amount that that individual can take advantage of. We're not going to get into the debate whether it applies for each spouse or only one per both spouses, but there is some question there. But let's focus on non-grantor trusts. So you've got an individual who can only take advantage of the one person's $10 million exclusion, but has $11.7 million of exemption amount right now. They use it or lose it exemption. So that individual can set up, let's say that individual has 3 children, can set up 3 non-grantor trusts. Just let's assume we split it equally, 3.9 million in a non-grantor trust for each child. Set up in a state like Delaware, so let's assume no state income taxes, asset protection, used up your exemption amount, great gift in estate tax planning, but also great income tax planning. Because let's say eventually this company is going to go public next year, it's going to more than double in value. Not only does the individual get a $10 million exclusion, but each one of those 3 trusts will get its own $10 million QSBS exclusion. So that means instead of just saving $10 million completely tax-free, in this case, the family as a whole saves $40 million. The individual and those 3 non-grantor trusts each get their own $10 million exclusion. Not only that, let's say the individual is in California subject to a 13.3% tax. So that individual has to pay $1.3 million in California taxes. Each of those non-grantor trusts located in a tax-free state doesn't necessarily have to pay any California taxes. Now, this is going to be subject to sourcing rules and throwback, but it's a non-grantor trust. So let's assume these are contingent beneficiaries. We're putting this trust in this non-grantor trust in a tax-friendly state. And this is really important for states like California that do not recognize QSBS at the state level. Now, you might say, why stop at 3? There's 3 children. Why not do 10 of these trusts or 50 or 100? What about these really big transactions? Let's set up as many trusts as we can. There is a limitation. Section 643F will treat 2 or more trusts as one trust if you have substantially the same grantor and beneficiaries and your principal purpose is avoidance of tax. So if it starts to look too similar, these non-grantor trusts, and sometimes people use the term stacking. If you start doing too many of these and they start to look too similar, you may not be able to treat these as separate trusts under 643F. We do have final regulations under 643F that came out in February 2019, but all they really do in the regulations is repeat the code section. What was scary is the original proposed regulations that came out in 2018 were going to presume that your principal purpose was tax avoidance of tax, unless you can show there was no way you could have done this without getting a significant tax benefit. And so, fortunately, those proposed regulations did not make it into the final regulation. So as of now, we don't have a lot of clarity on what makes it a multiple trust when you fall into the 643F rule. And unfortunately, you can't get a private letter ruling. The IRS and Treasury came out, Revenue Procedure 2021-3. They're not going to give you any comfort. The IRS said, we're not going to give you a ruling on multiple trusts under 643F. That just came out January 2021. So that's where we kind of are right now, except for these proposed rules that from the House of Representatives, the proposed reconciliation bill, HR 5376. So here we are in mid-October. What's going on? So what's in these proposed rules? What could pass? We don't know for sure. But the proposed legislation, it's buried there right at the end. I don't know if you guys want to read HR 5376, but on page 2213 of 2466, there is buried in there a rule that says after September 13th, 2021, you only get the 50% benefit if you're a taxpayer with adjusted gross income of $400,000 or more, or any trust or estate, regardless of adjusted gross income. So it doesn't mean that the QSBS benefit disappears, but what it does mean is that you're going to be limited to the 50% benefit as opposed to the 100% exclusion. So it's still a little bit of a benefit. Instead of, as I said, you're paying a roughly 14% tax on the greater of 10 million or 10 times basis, but you still have an AMT issue, you still have a 3.8% net investment income tax, and you might even have that new proposed 3% tax. So where does that all come from? Can Congress even do this? Well, real quickly, let me just give you a little background. Why do we have QSBS? Why is it even in the code? So going back to 1993, the legislative history is this was supposed to be targeted relief for investors who risk their funds in new ventures and small businesses. The QSBS exclusion was supposed to encourage the flow of capital to small businesses, many of which have difficulty attracting equity financing. And the other argument was small businesses need, quote unquote, patient equity capital. Now, that was the original exclusion of 50%. Why was it bumped up to 75% and then 100% in 2010? And then again, that original 100% was supposed to be temporary. The Obama administration in 2015 made it permanent. Now, once again, as we all like to advise our clients and remind other advisors, when Congress says something is permanent, what they're really saying is it doesn't automatically expire. But as we know in the tax world, nothing is permanent. So why these changes and why do they want to get rid of it now? Now, the original rules in 1993, that was the Clinton administration, 2009, 2010, 2015, Obama administration. These were all Democratic administrations. Why do the Democrats want to get rid of this now? I'll give you the three tax policy reasons. First, it's an expense. The nonpartisan Joint Committee on Taxation, their most recent report estimates a $1.8 billion cost just for 2021 for the qualified small business stock tax expenditure. So when you start adding that up and think about spending in a proposed reconciliation bill of $3.5 trillion, they're looking for as much tax savings as they can, meaning more tax revenue for the government to offset the cost of spending in the reconciliation bill. And by the way, that's just the Joint Committee on Taxation estimate. It's very likely a lot more expensive because those estimates are based on pre-September 27th or 28th, 2010 QSBS data because of the AMT preference and how it was reported. The second policy reason why get rid of it is because the largest share of QSB benefits likely go to very wealthy venture capitalists, founders, early employees of high growth companies. In other words, getting rid of this QSBS exclusion goes along with the general House theme of taxing people who have adjusted gross income of $400,000 or more, because that's who's mostly benefiting from this exclusion. And the third tax policy reason is the question of whether it actually even works. And the answer is nobody really knows. I mean, there is the debate, and you could say, look, Steve Jobs and Bill Gates, they certainly didn't have a QSBS benefit, but they went ahead and started companies. So would founders still start companies without this QSBS benefit? But even more importantly, what about the people investing in these companies? Would they still invest, or would they invest as much if they didn't get this tax benefit? We don't really know. The Congressional Research Service reported in 2016 there is no conclusive evidence that so this is in 2016, there is no conclusive evidence that the provision has had the intended effect of increasing the flow of equity capital to eligible firms. But then again, there's no conclusive evidence that it hasn't worked. So we just don't really know whether it's worked or hasn't worked, which brings me to my final comment, and that is, can Congress really do this? Let's remember that the provision in the tax code, the Internal Revenue Code, specifically said, look, if you start this company, if you invest in this company back after September 27, 2010, we will exclude 100% of your first greater of 10 million or 10 times basis. This was a promise in the code. This is what got people arguably to start businesses or at least invest in these businesses. Can you take it away retroactively? Remember, people have already done these transactions. Now, we know Congress could certainly say going forward, starting in 2022, you'll only get a 50% exclusion. But what about the people who have already been making these investments for the past 11 years? Maybe the only reason they did that and take that excessive risk with the small businesses because they thought they would get the better tax treatment. Can you really take that away retroactively? And unfortunately, the answer might be yes. And I'll just to put in perspective, for instance, in 1993, President Clinton and the administration at that time retroactively increased tax rates. in August of 93, going all the way back. So you could have had an individual that, let's say, sold something for short-term gains, thought in January of 93 they were only paying a 31% tax, and then they discovered in August of 1993 that they'd have to pay a 39.6% tax. Certainly you can raise taxes retroactively, and I'll leave you with even the Supreme Court in 1994. The Supreme Court in 1994 unanimously upheld a retroactive repeal of a tax deduction. This is the U.S. v. Carlton case in the Supreme Court, and what the court said in that case is that tax legislation is not a promise, and a taxpayer has no vested right in the Internal Revenue Code. So could this QSBS benefit at least get cut in half, if not more, with the 50% exclusion? And could it be done retroactively? Unfortunately, the answer might be yes. Now, will it be? Will it actually happen? As of October, at least mid-October 2021, we don't know for sure, but this has been proposed. And until we have certainty, at least we need to be familiar with some of the planning techniques, assuming this does not go forward in final legislation. And with that, I hope this was helpful to you, and I hope you all have a great day. Thank you.
Thank you, Justin, for the timely discussion of QSBS planning and the potential effect of proposed legislation on that planning.
Thank you for listening to this episode of ACTEC Trust and Estate Talk, the podcast series about wealth planning matters from the American College of Trust and Estate Counsel. To find an ACTEC lawyer near you, visit actec.org. Please subscribe to this series and leave us a rating or a review. Follow us on Facebook and Twitter at ACTEC Talk.